So it's really not in the best interest of governments to have any sort of financial education whatsoever, because that decreases the tax base. That's why I don't really see it changing. Some countries that don't have a global reserve currency can afford to do negative rates for a small period of time, but not for long, and not if you're the global reserve currency. And so once we hit 0%, which was in 2020, that ended that 4-year cycle. So if you're keeping track, 1940, 1980, 40 years of deleveraging. And then 1980 through 2020, 40 years of levering up. That peaked in 2020 and interest rates hit zero. Now they're moving the other way because inflation breaks out. And that's what happened in the 40s as well. What we're likely to see over the next couple of years to decades is yield curve control, more debt monetization, but ultimately that's government's way of printing themselves out so that they don't default. Number one, the political sentiment towards nuclear is changing because quite honestly, you can't violate the laws of physics forever. Unreliable sources like wind and solar are not even possible to get us there.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today, I'm delighted to be joined by Joseph Brown, who is from Heresy Financial YouTube channel. They have over 280,000 subscribers on their channel. And Joseph has a real talent for being able to break down really intensive financial concepts and then put them into very easily to digest videos for the listeners to understand. So welcome to the podcast, Joe. Really great to have you here.
Hey, well, thank you so much for the invite. I appreciate it.
So how's everything in Arizona?
Very well, good, but very hot. I think it's like 110 today, so kids have been swimming all day long, and it's a good summer as long as you have access to a pool.
Pool and air conditioning, yeah? Great. I'm really delighted that you can join me today. I really like your videos. I've been watching them for a while, and I really like the way that you're able to break down those really tough financial concepts, which can be quite tricky for the listeners to understand, and then put them into really easily to digest ways, and for people to be able to understand them a lot better. So congratulations on that, and congratulations on your growth of your channel as well.
Hey, well, thank you, and I appreciate that. It's really my goal, and it's driven by my own desire to, I run into something that seems, complex, and like, man, that doesn't really make sense. And so then once I'm able to kind of have it click, then I'm like, all right, well, I enjoyed that, so I want to share that with other people. And so that's kind of where the explaining things in more simple to understand ways comes from.
I just wanted to go over a little bit about your background and how you got into finance, where that passion came from, and a little bit maybe about how you started your channel and why you started your channel.
Yeah, absolutely. When my wife and I got married, we were about $30,000 in debt. I was making $4 an hour, not as like a waiter earning tips or anything. I was working at a nonprofit where I had to raise my own salary, fundraise for my own salary, and I was really bad at it. So I was making about $4 an hour. We had no money in our bank account, and I was like, man, like we are in a financial hole. And so I started just studying some basic personal money management, paying off debt, budgeting, things like that, and discovered the world of investing and what a mutual fund is and how compound interest works. And I kind of just fell in love with it. So I had a buddy who is a stockbroker, and he told me if I wanted, he could help me get a job in like the broker training program. So I jumped at that opportunity. I became a stockbroker, and over the course of the next few years, kind of jumped around a little bit, learned everything I could. It was always super interesting to me, getting into a new role, learning about different things, getting more licenses, understanding how options trading works versus portfolio allocation, and ultimately I ended up in sales and really ended in a position that I was making very good money, but I was really miserable. And at the same time, I had kind of started studying more macroeconomics, which if anybody who's listening is familiar with the financial industry, at least up until 2020, inside the financial industry, there's absolutely zero interest in macroeconomics. inside the financial industry, because the whole business is designed around just bringing assets in the door. Just you give us your money, let us manage it. We're going to charge you a fee, and that's the only thing that matters. Kind of understanding how the whole economic machine works is not really a concern. And so that really bothered me, especially once I started learning about how the economy really works and getting introduced to Austrian economics, realizing that, I was kind of, participating in a world that had things kind of backwards, and I really didn't believe in what I was selling anymore. So in 2019, I quit my job as a stockbroker. I started Heresy Financial. And that's what I've been doing since then, just trying to educate people about how markets really work. And on top of that, on top of the understanding of, economics and macro, investing and trading in order to really make money, understanding how things really work. And so that's what I've been doing since then. That's kind of the short of my story.
Yeah. And your channel, you've really grinded at it over the years. There's been a lot of consistency about doing regular videos in order to educate your listeners and the subscribers for your channel. Why are you passionate about financial investing education? Because that is one of the fundamental pillars of this YouTube podcast as well, is to try to educate people on financial concepts as much as possible as well.
Yeah, that's a great question. I think the main reason is because the more I've learned about how markets work, how the economy works, just financial literacy overall, the more money I've made. And like, if we can push this to like a hypothetical extreme, let's say every single individual in the world has really, really strong financial literacy, understands how the market works, understands how economics works. Well, number one, that means every individual is going to have their own financial life sorted out. We're not going to have people in massive amounts of debt. We're going to have people who are, budgeting wisely, investing wisely, just, have their own financial houses in order. But number two, what that also does is that actually fixes like the world's financial problems too. Like, I mean, when you look at the issues with governments and the mass amounts of sovereign debt crises really that the world is facing, that's a result of people taking actions that are incorrect actions based off of a misunderstanding about how economics works. I mean, ultimately, I don't think there are many people around the world who are in a position of power who are borrowing more in order to spend because they think it will destroy their own country. I think for the most part, people in power think that in the worst case scenario, it's just going to help them out with gaining more power. But even more than that, I think most of these people in positions of power are doing these things because they think it will actually be beneficial to their country. Even when you look at spending on infrastructure, like I would consider that like a bad use of money. But many governments who decide to do that think, oh, there's going to be a positive return on this, in our economy from this spending. And so, if everybody was financially educated, most financial problems around the world would cease to exist. And you wouldn't need welfare states. You wouldn't need, everybody would be responsible for themselves and actually be able to carry that burden. And if that was the case, most other problems would be solved as well, because not every problem is a money problem. And to be honest, money can't solve every problem, obviously, but money can solve every money problem. And most problems are just money problems in disguise. Whether you're looking at like the divorce rate, the number one reason for divorce is money. Whether you're looking at, most things can be broken down and ultimately would be solved if finances were in order. And so that's kind of where the passion and the mission comes from. Is hey, this is one thing that I know really well. I'm good at it. I like it. And I see how it kind of lies at the foundation of a lot of problems. And so I like to source things back to the root. I don't want to deal with symptoms. I want to get things back to the root. Like, if we can fix the foundation, the root cause, then all the symptoms will take care of themselves.
Yeah. And I think that in terms of the education system around the world as well, we're taught to learn skills that will get us into a job in an office or wherever that skill you might have that they want you to go and contribute to the wider economy. But I don't think they really teach people about investing or about finance in any kind of real life way. And I think that contributes to the problems because with investing, now I don't think it's a choice whether you need to know basic investing knowledge or not. I think it's very essential in your everyday life to be have at least a basic understanding of investing. And it's something that the school systems are not really addressing. Do you agree with that?
Yeah, in fact, if you look at the history of the public school system, well, for most of human history, schools were not public. There was not like a public school system. That was kind of invented by the Prussians in the late, it was either late 1700s or early 1800s. And the entire design of it was to churn out a military population. So they designed the school bells. You walk in line, you sit in desks, you wear a uniform. Like the whole thing was designed to indoctrinate and brainwash a population to grow up to be enlisted in military service. And in the 1800s, Rockefeller and a few others saw this system and they're like, we need this, but instead of for military application, we need this to churn out factory workers. And so they brought it back to the United States and had this big push to institute public schools in the United States for that exact purpose, to raise a population of employees and workers to fill up their factories. And again, a lot of those same things where it's like, all right, the test taking, the performing of certain tasks, the bells, the walking in lines, the asking permission to go to the bathroom, like, the whole public school system is really designed that way. And then when you look at how that kind of evolved, at least in the United States, the income tax didn't get instituted until teen. And so now the reason why that has become so embedded is because employees are where all of the taxes come from in the United States and the rest of the world. And so you have to have that continue if you want a tax base. Any financial education that happens, it's not like, personal finance, like budgeting, debt, understanding compounding interest, investing, like those are all very, very helpful. But to the extent that those would help people, people might be able to actually retire at a decent age, and then you have a smaller workforce, right? So ultimately, it's against not the wishes, but the interests of those in power to have financial education, even at the basic level. Now, when you talk about things like even just some basic understanding of how the tax code works in most countries, it's like most places around the world, the first thing you learn about taxes is, hey, I need to start a business. Because if I'm an employee, there's really not much I can do other than wait and delay my taxes until later by using something like an IRA or a 401k or a superannuation or some of the other tax programs around the world for retirement investing. But ultimately, those are not like ways to get out of taxes. Those are just to defer your taxes. And so it's really not in the best interest of governments to have any sort of financial education whatsoever, because that decreases the tax base. And so that's why it's become so embedded. And that's why I don't really see it changing outside of just personal interest in seeking that information outside of the mainstream.
Yeah, that's quite ironic, isn't it? That they don't want people to have a financial education, but at the same time, it's more and more needed because of inflation and the cost of living going up. It's more and more difficult to save money for retirement. So it's a quite ironic situation. I wanted to ask you as well. I know that you have a particular interest in Austrian economics. And I just wanted you to break down, if possible, why you have a strong interest in Austrian economics, and just break down the key concepts between Austrian economics and Keynesian economics, and the key differences between the two.
Yeah, absolutely. As far as I've been able to tell, it has the best explanatory power. So, an analogy that I really like, I heard from Dr. Robert Murphy. He was talking about this, and he's like, okay, when we go back to like Isaac Newton and his laws of physics and his explanation of how the universe works, that had the best explanatory power, accounting for all of the holes, all of the things that were not able to be easily explained. Overall, it was the best at the time. And then you fast forward to Einstein, you get general relativity, and it's like that explains everything that Newtonian physics explains, but also more. And so that theory gets, it gets replaced because there's a new one that has better explanatory power. And so that's a little bit how I feel about Austrian economics. It's like, yeah, you can point to some theories that explain how things might work in small isolated incidences. But when you kind of zoom out and try and take the whole economic machine all together, Austrian economics makes the most sense. And really, that's the only thing that I care about, is what makes the most sense in terms of, does it actually work out that way in reality? Because none of us, at the end of the day, we don't have any dog in this fight. It's like, if you come into this trying to defend one argument or another, you don't benefit by convincing somebody that you're right. You can only benefit by aligning yourself with the way reality actually is. And so, like, it doesn't offer any advantage to try and convince yourself or somebody else of something. What gives you the advantage is discovering what the truth is. And so that's kind of the approach of Austrian economics as well. It's not really trying to make any value statements of like, this is good or this is bad. It's just trying to be explanatory and descriptive of, hey, if this happens, then this will happen. And maybe you, as a human actor, you want this outcome. Well, then to you that would be good. To somebody else, maybe they would think that was bad. So we're not ascribing value propositions here of like, hey, taxes are bad. We're just saying, hey, this type of tax in this situation would result in this outcome. And so then you can choose whether you think that's good or bad based on whether you're the taxer or the taxee. So that's been my discovery process through, kind of learning about economics. And really what led me down that road was hitting roadblocks with, you go down like the mainstream paths of trying to figure out how this economic machine works. And the mainstream is really just a couple very closely related downstream offshoots of old Keynesian economics. And you start to look into these things and try and figure out, okay, well, like what causes bull markets and what causes the business cycle and how do these things relate and how do interest rates and inflation interact with these, trying to plug in all these variables. And at the end of the day, a lot of times it's just like, it's just, animal spirits. We don't really have an answer. It's just, that's the way things are. Sometimes things go up, sometimes things go down. It's like, well, maybe, but this guy over here is offering an explanation of the way things work that, number one, makes sense, and number two, explains all this stuff that you seemingly can't answer. And so that was one of the led me down that road, as well as kind of running into roadblocks with a lot of that stuff. So ultimately, what I think it would boil down to is understanding the role of money in an economy, what money actually is, understanding the role of the state and how really what it comes down to is force versus free choice in an economy. And so it requires a little bit of like, backing out and going to like first principles level thinking instead of just addressing the like really symptom level stuff of like the interest rates and the money printing and the taxing and the government spending and the business debt and the, all these things are like upper level, like more symptom level. The foundational, like the first principles level things that, are the root causes are more the money and the what is the money and the actions taken through force and then the actions taken through freedom or by choice.
Okay. All right. That's a good explanation. And also, if we look at the history of the US and US going off the gold standard in 1933 and then later 1971 as well. Obviously, it was a totally different financial system back then. Everything was obviously pegged against gold. And then obviously when they came off that, I think the US was really encouraged to print more and more money and kind of print their way out of obviously what happened in the Second World War and Vietnam and other things. They were encouraged to print as much money as possible to be able to stimulate their economy and keep it growing. Did you see that big switch between previously more kind of Austrian economic principles to more kind of Keynesian economic principles in terms of printing more money and for it to try and stimulate the economy?
Yeah, it's kind of been a long progression. I would say scaling up the same broken system. So, from a very basic example, you take a look at the original bank. It was a gold storage company. So, I've got a gold coin. It's worth more than a sandwich, so I don't want to carry it around in my pocket all day. It might get stolen. So, I'm going to give it to somebody and I'm going to pay them to hold on to it safely for me. And they're just going to give me, a little piece of paper. And on that, it says, I owe you 1 ounce of gold. And so now I could go take that in and get my gold to go buy a horse, or I could just leave that there and I could give that piece of paper to somebody else for their horse. And then if they want, they can go get that piece of gold. And so as those gold storage companies kind of evolved into banks, and the paper notes that were redeemable for that gold became more widely used and accepted as money, banks started offering loans because they realized nobody's coming in to get their gold. And so they offered a second service called loans. And so they said, hey, you guys are right now loaning to each other at 3%. I'll give you a loan for 2%. And so that you could undercut everybody because you have kind of an unlimited supply. So somebody comes in, you give them another piece of paper that says, I owe you 1 ounce of gold. And now, suddenly, since you've loaned money into existence, there's more paper in circulation than there ever was before. There's more money. You just caused inflation for the first time. And so by banks instituting fractional reserve banking for the first time, then you start that boom bust cycle where now there's more money, there's more spending, there's more economic activity, but it's all driven off of debt. And so when the debt starts to get repaid, everything unwinds and crashes. So you get the boom of the bust driven by debt, which is driven by money being loaned into existence from fractional reserve banking. And many times this caused a run on the bank. Many times it's caused inflation and deflation. Many times it's caused, people running the bankers out of town. Should have been outlawed. Instead, countries said, no, we're going to legalize this. We're just going to nationalize it. And so you had to have a banking license to do it. And then they established central banks so that every bank had a bank over it that was run by the government, so that if one bank started to get a run on the bank because they were engaging in fraud, fractional reserve banking, they could just draw on the reserves from the other banks so that they didn't actually go under. And within a very short amount of time, you had all sorts of bigger scaled up problems from this, like the collapse in Weimar Germany. You have hyperinflation from the Mississippi bubble in France. You have, when it got brought to America with the Federal Reserve, you have the first and the second Great Depression within the first 15 years of the Federal Reserve. So all these problems are scaled up. And then even past that, when they keep on going, you globalized it with the Bretton Woods Agreement after World War II, where the Federal Reserve became the central bank for the central banks around the world. But it's the exact same thing. Everybody gives them their gold. They get a little piece of paper that says, I can come get my gold at any time. Government printed way too many of those IOUs. Everybody caught on. They shipped them all back to the U.S. to try and get their gold. The U.S. says, well, we don't actually have the gold. So they shut the gold window. And so it's all just been kind of this big progression of, creating more claims on the money than money exists. And that was the kind of the last straw there, because now with no more connection to gold, that link was severed. So now instead of that money or that currency being a claim on real money, now the currency is just a claim on wealth. And so whenever you have more claims on that wealth being created, there is a run on the bank to redeem that claim on wealth for real wealth. That's what inflation is. When there's more money being printed, I'm going to go buy assets and goods and services, because if I wait too long, I will need more of these pieces of paper to get the same amount of stuff. So I might as well try and get it now, because if I wait too long, I'm going to be in the back of the line. I might not be able to get it. And that's exactly what inflation is. And I think we are kind of not destined, but almost certain to see a lot more of this, because governments around the world are facing giant debt crises, where if they keep on going the way they're going to default. It's either default, austerity and taxing, or print their way out of it. I think out of those three options, the most likely scenario is they try and print their way out of it.
Yeah. And I recently saw as well that in the US, obviously the debt is in the absolute trillions. Probably no way of that ever getting paid back in any meaningful way. Have to be inflated away over time. And the debt to GDP is, I think it's over 120% now. Can you ever see a scenario where that continues to increase over time and you get to kind of levels which we're seeing in Japan and in other countries where it's over 200%? Can you envisage that for the future in the US economy?
Yeah, I mean, it's possible. Most of the time, there's a book called This Time is Different by Kenneth Rogoff. And so these guys have kind of shown usually 90% is the tipping point, but the real tipping point is closer, is 120%, where if you get there, it's really, really difficult to come back from that. So the US has been at 120% before. It was like 1943 or something like that when we hit 120%. And that was because of all the borrowing to spend on World War II. Now, that resolved itself. We deleveraged from there from 1940 through 1980 all the way down to, and by deleverage, I'm talking about the government here, by the way. So the government deleveraged themselves, and you measure that by the amount of debt they have versus the size of the economy, so GDP, debt to GDP, it went from 120% down to like 33% from 1940 to 1980. And so they did that through printing. So rates went up, inflation went up, and they printed their way out of it. So there was yield curve control, there was printing. The 1970 delink from gold happens. There's a bunch of printing there. Like it was an inflationary deleveraging, but it was a deleveraging for the government nonetheless. And the 40 years following that, from 1980 all the way through 2020, was the opposite. It was levering up because when interest rates, start at, what were they like? For some interest rates, were up at like 18, 19%. And so when they start really, really high, and then they go down, it's like, well, I can afford more debt now for the same monthly payment. And then interest rates go down, well, I can lever up even more and have the same monthly payment. So, as normal with population growth and increases in productivity, you're going to have the growth of the economy. So, not only can the government lever up more from just the cost of the debt decreasing because interest rates are going down, but also because the tax base is growing from the economy growing. So, because of both of those, from 1980 through 2020, the government levered up like insane amounts. So that has all other sort of knock-on effects. But once interest rates hit zero, you can't keep going that direction. Not if you're the global reserve currency.
Yeah, you end up in negative, and that has negative connotations too, right?
Exactly. Yeah. And some countries that don't have the global reserve currency can afford to do negative rates for a small period of time, but not for long, and not if you're the global reserve currency. And so once we hit 0%, which was in 2020, that ended that 40-year cycle. So if you're keeping track, 1940, 1980, 40 years of deleveraging. And then 1980 through 2020, 40 years of levering up. That peaked in 2020 when the leverage hit. It hit like a peak of 124%, and interest rates hit zero. Now they're moving the other way because inflation breaks out. And that's what happened in the 40s as well. And so inflation breaks out. What we're likely to see over the next couple years to decades is yield curve control, more debt monetization from between central banks and governments around the world, which means more inflation, which means higher rates. But ultimately, that's government's way of printing themselves out so that they don't default. And so, yes, that ratio will improve as the governments deleverage, but that also means that pain or the cost of that is being offloaded onto the economy through higher prices and a lower cost of living. And that's, again, all else being equal. It's possible we have a giant productivity boom and gains in economic growth from things like resurgence of nuclear fission energy around the world, and AI and robotics, and many other things that have the potential to drastically increase productive output around the world. So we can offset the pain from that, but all else being equal, all that cost is going to be borne by the public through governments inflating it away.
Okay. And do you expect over the coming years, so you mentioned that cycle kind of stopped in 2020, and now obviously interest rates increase pretty significantly over the last couple of years. Do you expect us to have higher interest rates for longer? And do you think that the days of 0% interest rates are now done, and that we might be in for a period of more sticky inflation like we had in the 1970s, for example, in which might warrant that the Fed would have to keep interest rates higher for longer? Even if they do decrease them, they still won't get back to those zero levels. What's your view on that?
Yeah. I mean, historically speaking, when you look at a long term history, interest rates are still actually lower than normal right now. And they're higher than they've been for the last, 10 to 15 years. So in recent public memory, it feels very painful for rates to be here. But when you look at like hundreds of years, long term history, interest rates are still pretty low. When you look at kind of the way that the cycle plays out and the drivers of this long term debt cycle that I'm talking about, really what we have to look at right now is, okay, the government has $34 trillion of debt. Right now, the interest cost on that debt. So if the debt stays the same, and I'm using the US, but every government is in the same position. If the debt stays the same, which we know it's not, the debt's actually growing very quickly because there are huge deficits. But let's just assume the debt stays the same. The interest portion on the budget, just to maintain the debt, actually keeps on going up because they have a lot of debt that they borrowed 2 years ago, 5 years ago, 10 years ago, or longer. And That was when interest rates were 0, 1, 2%. Right now, interest rates are 4 or 5%. So just maintaining the debt right now, the interest alone to pay for that national debt to maintain it is $1.2 trillion. Assuming nothing changes, the interest on the national debt will very quickly hit 1.6, 1.7 trillion. That'd be 5% on 34 trillion. But we know that the debt is not just staying here, the debt's actually growing. So not only is the debt growing, but it's growing because we have to borrow more to pay the interest because we're running deficits. So we're borrowing more to pay that interest. And the interest itself is growing because you're paying off old debt, which was cheaper, and replacing it with new debt, which is more expensive. Not only that, if that wasn't bad enough, they're doing this all by borrowing at the short end of the curve. So the majority of US government borrowing is short term debt, like under a year. And that's despite the fact that if they borrow with by issuing 20 or 30-year bonds, they'd be paying a lower interest rate on that. Well, they can't do that because nobody's actually lending for 20, 30 years. They don't want to break the treasury markets and have a failed auction. So they're just borrowing at the short end of the curve, even though it's more expensive in the short term. They think, oh, we can fix this problem later. And so they're borrowing at the most expensive rate possible right now. And so all these problems combined mean the cost just to keep the debt is growing at an exponential pace. This is a problem that will manifest within the next couple of years. This is a problem that cannot just continue. Like, you can't just keep on going down this road. Something has to happen to be able to pay for it. And so the thing that happens to pay for it is the money printing. Eventually, when they try and issue debt to borrow to pay their next month's bills, there's not going to be the dollars that they need coming in for that bond issue. The dollars just are going to be all soaked up out of the system. And so we got to create new dollars. That's what money printing is. So they're going to call on the Fed. The Fed's going to buy those bonds off the market, replace some of those assets with some of those dollars, and then those dollars can make their way to the government in the form of new loans. And so that's what debt monetization or quantitative easing is. As that happens, now suddenly government borrowing is really new money being printed, and that's new money coming in, chasing the same amount of goods and services. So that's pushing prices up. As prices go up, that means inflation, which means higher rates. And so, yes, the government is going to get new printed money to pay for all their bills, but that means more inflation and higher rates for everybody else. This is the exact same thing, by the way, that happened in the 40s during this last government deleveraging. For 4 decades straight, interest rates moved up, even though there was yield curve control and debt monetization, even though we had these things happening. Inflation and interest rates both moved up in lockstep for about 40 years. I don't know whether it's going to be for the next 40 years from here. It might be a lot shorter. There's like no magical law that says, hey, this debt cycle lasts for 40 years between phases, but it's not going to be done in 1 year. It's definitely a long-term thing we're looking at.
Yeah. Yeah, I agree with you on that, actually, because I do think that what we're experiencing now is more similar to the 1940s than the 1970s, right? Because the 1940s was obviously caused by the high costs of war, right? And there wasn't a lot of productivity in the economy because of the war. And after the war, when things started to pick up and the economy started to pick up, there was a lot more productivity and they started printing money and inflation became more and more. And I think with what happened in 2020 with the pandemic, I do think it was quite similar because there was a disruption in the economy. It caused problems with the supply chain, etc. And this kind of moved towards what we saw when the economy started back up again. We had a lot of economic activity. And then that translated into, obviously, they were printing money during the tough times. And then that translated into high inflation. So although it wasn't caused by a war, it was caused by a disruption. So I do think that there is probably more similarities to 1940 than 1970.
Yeah, one of the differences is that the spending, even though like you could say the similarity is like, okay, they were spending on a war, we're spending on a pandemic. The difference is that it never stopped. Like the spending has actually continued. And if we were to just like decrease spending back down to the same level that it was in 2019, the US government would actually be running a surplus right now. That's how much, that's why I always say this, it's never an income issue with the governments, it's always an expenses issue. There's no such thing as get more taxes and you'll fix the budget, because if you look at how much the government takes in taxes every year, that number goes up. It's just a straight line up. And if the government was to reduce its spending to 2019 levels, which was just a year before COVID happened, the government would be running a surplus right now. And so not only did they drastically increase expenses and borrowing, so that deficit for 2020, but they just kept it going, even though there's no need to continue that spending right now. You could make the argument that some things cost more now because of the inflation, but not to the level that it's sustained.
Yes, I think so. They continue to spend more and more money, and that hole just gets bigger, right? It's impossible to fill with just by getting more tax dollars in. So, yeah, I totally agree with that. All right. And I saw in a video recently that you posted on your channel about that you saw some recession signals that hadn't been seen since 2008 and before that in 1929. Can you just explain what some of those signals are and what caused you to make that video?
Yeah, certainly. One of the biggest things is this might be a little bit updated for today since I made that video. One of the things that is going to always keep the economy going is people making more money and then spending that money. So versus something like Japan. We look at Japan and be like, oh, they printed money forever and then, they never had inflation. Well, when you look at what actually happened with the broad money supply, they didn't actually have an increase in the broad money supply there because all of that money printing the central bank was trying to do, people individually were deleveraging, they were saving, they were paying off debt. And so that was like a counterbalance against what the monetary policy was trying to do. This is why culture is such a big deal in economics. And when you, or I should say, individual human action is the driver in economics. And so when you look at Americans and jobs and income and spending, typically with the average American, you make more money, you're going to spend more money. You have a couple $100 extra in your paycheck because you got a raise. Now I can afford to trade in my Honda Civic for a BMW. So you're going to make more, you're going to spend more. And so it's kind of like this wage price spiral that you look at. And there's some arguments that sometimes you can see like those things are healthy. What we're mostly seeing right now in terms of employment and spending, number one, we are seeing an increase in the number of jobs that people have on average. So you do a survey of jobs and you go to Taco Bell and McDonald's and Burger King and you say, how many employees did you have last month? And altogether they've got 300 employees, these locations. Next month, altogether they have 310 employees. And you're like, great, you're hiring people. We just added 10 jobs to the economy. Well, there's a different survey where they actually go and ask individuals. They say, do you have a job? Do you have more than one job? Or do you have no job? And, last month they ask and they're like, okay, we got 300 people who have jobs. Next month, 300 people who have jobs, or 295 people who have jobs. And there's, 15 people who have more than one job. And so what we are seeing is not the fact that people who don't have jobs before are getting jobs now. What we're actually seeing is people are being laid off, full-time employment is going down, and then people are getting multiple jobs to make up the difference. And so part-time employment is going up, multiple jobs are going up. So these are actually very bad job indicators. You have people losing benefits, you have people losing pay. And so the establishment surveys that just ask the companies how many employees you have, they don't capture the fact that it's the same person working at Taco Bell and McDonald's and Burger King for that job that's counted 3 times in the establishment survey. That's only one person in the household survey. And so that's a big deal. Another big deal is that most of the credit card debt is concentrated in the bottom 49%, or I should just say among 49% of Americans, not necessarily the bottom. So when you rank Americans by credit card debt, the median American has $0 in credit card debt, which is actually a pretty good stat. You think, okay, well, great. Like 51% of Americans have absolutely zero credit card debt. That's great. Until you look at how much credit card exists and that it's at a record, I think 1.6 or $1.7 trillion right now. All of that is concentrated among the minority of Americans. Not only that, but delinquencies for credit card debt skyrocketing right now. Not only that, but the fact that the balances are going up to a record amount and the fact that interest rates on credit card debt are at a record high. This is bad news. We're seeing defaults and delinquencies start to really grow right now. Essentially, it means that people have tapped out their savings, people have tapped out their debt, and are not going to be able to continue this spending. And they're also tapped out on jobs because they're continuing that. If you've got two Part-time jobs, maybe you can fit a third in, but what happens when that's not enough to pay the bills?
You need to sleep as well, right?
Exactly. You need to sleep, you need to eat. If you have kids, it's a very bad sign. So, in terms of you got somebody to care for now, and that's just the job side and the credit card debt side. There are some other ones as well, but we are seeing a lot of signs that the economy is really, really not that strong right now, which makes sense. After you have an inflationary boom, you usually have a deflationary bust. And if you try and paper over that by extra printing or just a little bit of the right amount of printing, ultimately that might not show up in like GDP numbers, but the economic pain is still born, regardless of what the numbers show.
So you think people will just, as the credit card debt goes up and people max out their limits, you think they're just likely to spend less? So we're going to see a lot less consumer spending, which will roll into the economy.
Yeah, I mean, it's kind of like sometimes it's not by choice. There's certainly, I mean, with retail sales numbers are looking like that rollover is happening, but sometimes it's just like you were spending on your credit card before, but now you're maxed out. You're not able to spend more on your credit card, and now it's like maybe if you do want to act on choice and try and pay some of that off, well, that's money that you're no longer spending on something else. You're not buying that extra food anymore, or maybe it's like you're actually cutting back on some things that you thought you actually needed, and you're using that to deleverage yourself instead, or at least just like make you know minimum payments that are getting larger and larger because of the interest rate. So a lot of times it's not by choice, but yeah, when you have a large percentage of the population who can't spend as much anymore, then certainly overall consumption is down, and that's smaller revenues and profits for companies, which then means layoffs, which then means pay cuts, and feeds back in on itself.
Okay. All right. And I wanted to ask you about globalization versus localization now, because I think over a number of decades, if not longer, we were moving into a really globalized world where there was a lot of efficiencies in the economy by having a globalized world, right? Things were concentrated on being made in certain countries, China, in other countries as well, which had a cost saving advantage for consumers around the world. But myself, I noticed that start to change in really around the 2020 time during the pandemic when there was all those supply chain issues, because obviously when there's a threat of supply, that increases inflation and the costs of goods and services come up. And it really shows your bottlenecks in the economy, right, when stuff like that happens. How do you see the recent move from globalization to localization playing out? And do you think that could be in place for quite a long time? And what are the drivers of a shift from globalization to localization?
Yeah, that's a good question, and this might actually be something that I've changed my mind on a little bit recently. The traditional narrative is that globalization is something that started a few decades ago, maybe up to 40, 50 years ago, and increased to a crazy amount. It was net negative, and now from here on into the future, we're going to see a reversal of that and more localization or deglobalization. The issue with that is like when you take a longer view of history, they found shipwrecks from thousands of years ago, where on the ship they have artifacts or like supplies from literally all over the world. So there was this one boat that they found, and it was 1,500 years old, and there were I'm going to get the details wrong here, but the overall point is correct. Spices from Egypt and money from Asia and styles from Europe, and it was just a merchant ship. Like kind of like a modern day shipping container, and it had stuff from literally all around the world. Global trade, while it definitely hasn't been as efficient as it is today, has always existed. Globalization has really always been there. I mean, that was the whole reason why people were trying to make it around to Asia, which led to the rediscovery of the Americas. And so that globalization is the traditional globalization story, I think, is a little bit overblown. And the threat of deglobalization, I think, is overblown as well. When you when you look at the stuff that's been happening recently, that it does seem a little bit more like deglobalization. A lot of that is political allegiances changing, and we could certainly see negative outcomes around the world that result in more and more localization and less cooperation around the world. But that harms everybody. Like ultimately, having manufacturing in China over the last 30 years has been a net benefit to everybody on net. There are certain individuals who have lost their jobs, but it's like, why is your labor worth more than somebody else's labor? If somebody else is a human and they're willing to do the same job you're willing to do, and they're willing to do it for a fraction of the cost, what right do you have to get a law passed to stop that from happening by force? If I want to voluntarily associate with somebody, regardless of where they live in the world, what right do you have to tell me I cannot do that, to stop this free exchange from happening? And so ultimately, the more freedom that we have, the more globalization we're going to have. And the only way that that reverses itself is through force. And that's really not a great future to look forward to. And because it results in negative outcomes for anybody who participates in trying to get the deglobalization to happen, well, then you have an advantage that appears to anybody who participates in globalization, which means that there's kind of like a game theory going on where it's like, well, if I want to be able to compete, then I have to be open and willing to play this game as well. And so I am not as convinced as I used to be that we are headed into a long term period of extreme deglobalization.
Yeah, I think some of it could just come in pockets of the economy, right? Things that are very vital. So obviously when Russia had the issues with Ukraine, that that did cause some energy shortages because of the dependence, especially in Europe, but also US as well. They had some dependence on Russian oil and gas, which caused some shortages and caused the spike of prices to go up in terms of energy. So that's one example. I guess the other example as well would probably be with China as well, and some of the geopolitical tensions between the US and China. I guess that's also a threat as well, and Taiwan and the semiconductor industry. So there are probably pockets there of threats from geopolitical issues and other areas. But I agree with you. I don't think it's going to be a case where everything that's going to be manufactured in the US again. I don't think we go back to those times. I think it'd just be a slightly stripped back version of globalization.
For sure. And to the extent that, like, I mean, if you just let this play out, then eventually enough money comes into those places that are cheap for manufacturing, bids up the prices there, and you then have more equal playing field around the world over a longer time horizon. And then it's just play to your strengths. It's the same reason why on one block, one person might have a doctor's office and the other person is running a restaurant, and the doctor pays the restaurant for their lunch, even though they can make their own lunch for cheaper because they have a relative advantage by spending more time working for the time that they would be spending making their own lunch. It's the same thing on a global scale. And so you do have more evening of the playing field as that arbitrage opportunity goes away, but you still have everybody playing to their own relative advantage and relative strength.
Okay. And on that arbitrage opportunity that you just mentioned as well, I guess that could also equate to governments as well, right? So if we look at, obviously, US has been the global reserve currency since Bretton Woods. And then obviously before that, it was UK for a long period of time. And then before that, I think it was even Portugal for 100 years or so. With globalization being stripped back, can you see a weakening of power, not so much weakening of the currency, but a weakening of power of the US dollar as more economies are involved in the economy? Can you see a stripped back power from the US dollar from other countries?
Yeah, definitely. I think it takes a lot longer for these things to play out than people think. So Again, this is something that I've changed my mind on over the last probably 2 years, because I used to see these, some signs and see what was happening with Russia and BRICS and, China buying gold and, a lot of these things. It looks like, oh man, like everybody's trying to get rid of the dollar. But if you dig a little bit deeper and you see, okay, well, what would that do to this country if they push this a little bit too far? Well, it would hurt them more. What would happen? What would happen if this country did try and de-dollarize? Well, they would default on all of their dollar-denominated debt, all the dollars that they owe. Like they owe dollars, so they can't de-dollarize. They have to get dollars so that they can pay back their dollar debt. And ultimately, because debt has interest, that's a game that just keeps on going on a global scale. And so it's really the global debt game that keeps the dollar kind of centered at that foundation. And even like in South America, a lot of these countries that you see headlines, hey, they're de-dollarizing, they're starting to have contracts with other countries denominated in other currencies. When you dig a little bit, you're like, oh, the reason is because they have a dollar shortage and they're trying to preserve their dollars for something else. Like they're doing this because they want more dollars, not because they want less dollars. And again, it's the debt that causes this. And there's, by some accounts, $100 trillion of dollar denominated debt. And that means another country that borrowed dollars from somebody else who had dollars and now owes dollars back. And, that's all around the world. And so that doesn't go away quickly, doesn't go away by a few countries trying to choose to force it to happen. That's something that plays out over time. And from a very, very big policy error on the overcreation of new dollars. And based on what happened 4 years ago, the inflation that caused, I would not expect a large percentage increase in the number of dollars based on monetary policy anytime soon. That is something that happens at the tail end of this phase of the debt cycle. So 40s and today the 20s are similar. You fast forward from the 40s, you get to the 70s. That's when we delinked from gold, and there was the big kind of like the crack up boom there. It's not happening at the beginning end here during the 20s. That's something that happens at the end when the dollar has lost a lot of purchasing power. Then suddenly countries are in the position to dump treasuries. The Federal Reserve has to monetize it all. Dollars get shipped out around the world. They all get shipped back to buy American produce and assets. And you have a big crack up boom that kind of ends the dollar's reign. But that's not something that happens now. That's something that happens, in my opinion, probably a few decades from now.
Yeah. Yeah, I agree with that. And I think in order for it to change, there has to be a better currency, or there has to be something that replaces it, where everybody around the world thinks that this is a better form of money, and it's our benefit to move over to this. And I think maybe some of it is political posturing as well from the different countries like China, Russia, etc., because they don't really want the US to weaponize the dollar, to be using the dollar as a weapon in order to exert power over other countries, right? So I think some of it might just be a little bit of a shift over to try and reduce a little bit of that power that the US has. But I generally don't think that there, at this current time, there's probably not a better instrument that they can all agree on at the moment.
Yeah, yeah, I agree.
Okay. And lastly, I wanted to talk about energy, so oil and gas and nuclear. I noticed that you were particularly bullish on the future of nuclear energy in the economy. Can you just a little bit talk about your thesis on nuclear energy and why you're so bullish that it could be a major part of our lives in the future?
Yeah, absolutely. A couple of things. Number one, the political sentiment towards nuclear. And when I say nuclear, I'm talking about fission. So the traditional nuclear. I'm not talking about future fusion, which is 10 years away and always has been, and I'll probably always will be. So we're talking about fission, just regular nuclear power reactors. Number one, the political sentiment is changing because, quite honestly, you can't violate the laws of physics forever. You run into a wall. They're realizing, hey, we've got power needs. unreliable sources like wind and solar are not even possible to get us there. Number two, popular sentiment is changing. When you look at the approval for nuclear power, it used to be for both the left and the right, it used to be down in like the 20 to 30% range. Within the last like 5 years, it's just shot up and is around for both the left and the right around the 70 to 80% approval range. The reason for that is actually really cool. It's just education. And this is, again, this is bipartisan. It's not coming from only the left or the right. When you look at the education that is being distributed about nuclear, you realize a couple of things. That number one, everything that people thought about nuclear since like the 70s is wrong. Like, it's all propaganda, most likely propaganda developed and pushed by oil, who is the only one threatened by a massive nuclear renaissance. Number three, I guess some of those facts are, it's like, and these are facts I don't have time to like, we don't have time to like go into them, but I would highly encourage anybody listening to like go like try and fact check this, because what you'll discover is, oh my gosh, I can't believe this is crazy. Like, this is true. It's crazy, but it's true. Like, number one, it's the safest. All of the people who have ever died in history from nuclear energy production is less than the number of people who die every year from wind and solar. Go fact check me. It's true. Number two, it's the cleanest. It is the only cleanest and greenest. It's the only energy production that sequesters its waste from the environment. All other production forms send their exhaust or their waste back out into the environment in terms of like smoke or particulates or toxic leaching metals into landfills and being buried underground, even wind and solar. Number three, it is constant, meaning like it just provides baseload power. It's not like an unreliable energy that relies on conditions, going on and off. Number four, it's the densest form of energy production. So you need about 1 square mile to produce the same amount of energy that you need hundreds of square miles from wind or solar. You don't have to do any like, massive drilling. You don't have to do massive, ecological changing. You don't have to do like massive dams that change the entire local environments. You don't have to kill off tons of birds or animals. The amount of radiation you get from working at a nuclear power plant is the same amount that you get from eating a banana. So it's just like the nuclear waste. That's been solved for years. Number one, you have reactors now that can actually use the waste as fuel. But number two, when the burying of the waste, that's in earthquake proof casks, like literally, like actually earthquake proof, below the water tables, literally impossible for anything man-made or earth-made to cause that to get out, leach out into anything that humans interact with ever for all of human history into the future. It is an absolutely solved thing. The US Navy has been running, it's to this day 6,000 years of combined nuclear time of nuclear reactors running, zero accidents, accident free. One nuclear submarine lasts literally forever. Like, every city can have one of those. Every big building can have one of those. And people are waking up to this. They're realizing it. They're getting educated, and they're realizing, oh man, like, we need this. Now, the question is, well, like, how are we actually going to get that to happen? And the answer is big tech. This is one of the coolest things about AI. When you look at some of the things that are happening, like Oklo, OKLO, it's a company that just went public through a merger with a SPAC. It is a small modular reactor nuclear company that is specifically going after like server farms and like commercial projects where there's big tech companies that need big energy, and they're making small modular reactors for that. They make reactors that use waste as fuel, and they are passively regulated, meaning meltdowns are not possible, and really, really cool. But that's just one by big tech company. Sam Altman is above that. He's the AI guy. Amazon just purchased a nuclear power plant, one of their big properties with a ton of energy needs. So big tech is realizing we've got a bunch of energy needs. We're going to have a bunch more in the future. The only way we are going to get this is nuclear. They're going to fund the lobbyists and get pushed to get things turned around and changed. So change is coming. It's a kind of a matter of physics. Really, it's the only option. There is no other energy production that can meet the energy needs. So I'm extremely bullish on that. And therefore, those companies like Oklo and Uranium, I'm a shareholder, so I'm biased, obviously. And all other energy production as well. Like, we're moving into a future with this is always human history, more energy needs in the future than we have right now. Natural gas is extremely underpriced right now. I'm very bullish on that. And so if you're looking for something other than uranium, I like natural gas a lot right now. But that's my nuclear pitch.
It makes a lot of sense because people want to have control, like companies especially want to have control over the energy consumption, right? And by getting a lot of natural gas and other energy from other countries, it makes sense for countries to be building their own nuclear reactors in order to ensure that they have their energy supply sustainable for long periods of time. I think nuclear really just had it was more a PR problem over the last couple of decades because of what happened with Fukushima and other nuclear reactors and spills. And I think it was more of a PR problem to justify to the rest of the country, even though it's super safe, to justify them building these nuclear reactors. Because people say, oh, well, what happens if there's a nuclear spill out? But I think I have seen that shifting over the last couple of years. I think because of this geopolitical issues and this slightly de-escalating of globalization as well. So, yeah, I agree. I'm also very bullish on nuclear. So that's great. All right, just because we're an education channel, just like your own YouTube channel, I wanted to just end on one of the videos that I saw on your channel around how investors and how people can have a dependable path to wealth. And I wanted to get your tips for the general listener on how they can navigate the waters of investing and how they can eventually go on that path to having wealth.
Yeah, absolutely. I'll start off with the basics. Number one, I think most important, you need to focus on increasing your income. For the vast majority of people, this is either going to be getting into a sales position or starting a business. The reason why is because pretty much any other job that you can possibly get, you're never going to make enough money to be able to, number one, comfortably be able to afford all of your needs and also have a substantial amount of money left over to be able to invest and buy assets with. Most of the time, most jobs, even like doctors, especially considering how much you have to pay to get degrees these days, you're going to be making just enough money to be comfortable and then have a little bit left over. And most people are just going to be trying to be more comfortable with that. Like it's not going to be enough. And so a sales position is something where your income for most sales positions is unlimited just based on what you sell. You start off with selling something small, you get good at that, you sell something bigger, then move to sell something bigger and then bigger, and your income can go up an unlimited amount just based off of what you're selling. And it's the same skill, you're just applying that to other areas. So that's one almost unlimited income area. The second is starting a business because then you're just, it's between you and your customers are the only people determining your income. And so that's going to be number one, increase your income. Number two is you actually have to spend less than you earn, right? Because you can outspend any income. That's why professional athletes and lottery winners go bankrupt. So you have to learn how to budget. You have to learn how to spend less than you make. And the dollar difference is what matters. So somebody who saves or somebody saves 50% of $50,000 income, you think 50%, that's great. You're saving a lot. That's only 25 grand. But if you're saving, let's say 10% of a $500,000 income, well, 10% is not that much, but it's still double the amount of the person who's saving 50%. So it's about the dollar amount. So you got to increase your income and spend as little as possible. Now it's okay, what do I do with that? Now it's study how to invest. You have to buy assets. You have to understand some sort of strategy for investing, whether it's technical analysis for trading, whether it's value investing and fundamental analysis to buy assets. You've got to have some sort of strategic approach to buying assets. We're not just dollar cost averaging into the entire stock market around the entire world and hoping that it's worth more when we retire someday. And so making more, spending less, investing that in assets. And that's kind of the 3-step approach that summarizes 90% of what you need to know. And there's details involved in that, but don't worry about the details until you get to step 1.
Can you just tell the audience how they can find out more about you?
That's where I would go. It's Heresy Financial on YouTube and on Twitter, Rumble, Instagram, TikTok, everywhere. But I'm going to be putting out I'm always putting out most consistently on YouTube. So you can find me there and enjoy.
Okay, I'll leave the details in the description. Go and watch Joseph's videos to find out more about that. Thank you very much for this really great discussion today. I really enjoyed talking with you, and I think it gave a really good insight into the financial markets for the average listener. So, really, thank you a lot for your time, and I really enjoyed the discussion.
Thank you so much for having me. It was a good time.